Carried interest and management fees. How private equity fund managers really get paid. Hello and welcome to CandiMentor. Today we'll break down the economic engine of private equity, how fund managers earn management fees and carried interest, and how the distribution waterfall decides who gets paid first, next, and last. We'll keep it step by step and TTS friendly so you can speak it aloud or use it as a voiceover script. What GP compensation model represents private equity? Uses a dual income model for managers. One part is predictable, the management fee. The other part is performance-based, carried interest or carry. Together they align the GP's incentives with LP returns. Think fixed pay to run the firm, plus a share of upside when things go well. End. Components of GP compensation. There are 3 building blocks. 1. Management fees cover running the shop, salaries, offices, research. 2. Carried interest, carry, the GP's portion of profits when returns exceed thresholds. 3. Co-invest, GP commitment, the GP's own money invested alongside LPs, providing skin in the game. Each part sends a different signal: stability, performance, and alignment. Management fees, core idea. Management fees are the fund's operating budget. They are charged annually and paid regardless of fund performance. They keep analysts paid, cover travel and due diligence, and fund compliance. In short, they keep the GP operational while value creation happens. Fee basis and rate. Typical industry practice. Charge about 1.5 to 2% per year. During the investment period, the fee is usually on total commitments. After that, fees often shift to being on invested capital or NAV. Fees commonly decline as the fund matures. Early years need more active work. Journal entry, management fees. How it hits the books. On the fund's books, doctor, management fee expense, creditor, bank payable. On the GP's books when received, doctor, bank receivable, creditor, management fee income. If fees are credited against LP commitments, doctor, management fee expense, creditor, LP contributed capital, or fees payable. Keep entries transparent to show economics clearly. Right. What carried interest means. Carried interest is the GP's performance fee. Common split, 20% carry to GP. But carry is paid only after LPs recover their capital and often a preferred return. It is the main mechanism through which GPs generate outsized personal wealth. Carry trigger conditions. Carry appears only after several conditions are satisfied. LPs must receive back contributed capital. The preferred return, or hurdle, must be achieved. Catch-up mechanics must be fulfilled if the waterfall uses catch-up. Only then does the GP begin to receive carried interest. Preferred return hurdle rate. A preferred return is the minimum IRR LPs must receive. Common hurdles range from 6 to 8% annual IRR. The hurdle protects LPs. GP only earns carry after the hurdle is paid. It forces GP focus on real performance, not just nominal exits. The waterfall, top-level flow. The waterfall is the distribution order. A standard flow is 1. Return LP contributed capital. 2. Pay LP preferred return, hurdle. 3. GP catch-up. 4. Residual profits split. Commonly 80% to LPs and 20% to GP. Each step must be implemented exactly as set out in the limited partnership agreement. Step 1. Return of capital. First rule: LPs get their money back. Exit proceeds first repay the capital that LPs actually paid in. No carry is paid during this phase. Journal entry, cash out, Dr. LP capital accounts, credit bank. This preserves capital first priority. End. Step 2. preferred return accrual. Next, LPs earn the agreed hurdle on contributed capital. This accrues over time and is often calculated on cumulative paid-in amounts. Entry to recognize accrual. Dr. Fund retained earnings. Credit LP preferred return allocation. This step ensures LPs receive an economic cushion before GP profit share. Step 3. GP catch-up mechanics. After the hurdle, some waterfalls include a catch-up. During catch-up, GP receives distributions at a faster rate until its contractual share, e.g., 20%, is met. Example logic. GP receives 100% of distributions during catch-up until overall profit split matches 80-20. Accounting entry. Doctor retained earnings, GP carry allocation. Catch-up aligns interim distributions with final split. Step 4. Residual split, 80-20. Once the capital and hurdle and catch-up are satisfied, remaining profits are split. Common split, 80% to LPs, 20% to GP. Journal entry. Doctor Fund profit allocation. Credit LP profit allocation, 80%. Credit GP carried interest, 20%. This is where the GP's long-term incentive pays out on sustained performance. American versus European waterfalls. Two structural flavors. American, deal by deal. GP may earn carry on each profitable exit immediately. European, fund as a whole. GP only earns carry once the entire fund returns capital plus hurdle. American equals faster payoff for GP, but higher clawback risk. European equals more conservative, LP-friendly, and reduces clawback probability. Catch-up structures, variations. Catch-up can be full or partial. Full catch-up. GP gets 100% of distributions until it reaches the agreed carry portion. Partial catch-up. Distributions split in a defined ratio. Example, 50-50 until alignment. LPs and GPs negotiate this to balance risk and timing of payouts. Clawback mechanism. Clawback protects LPs from early overpayments of carry. If early exits produce carry, but later losses reverse overall economics, GP may need to return excess carry at fund windup. Mechanisms include escrow of some carry or GP partner guarantees. Clawback is a crucial LP safeguard. This is a crucial LP safeguard. Carry accrual during fund life. Funds commonly accrue estimated carry as NAV movements occur. Accounting entry when accrual is recorded. Doctor carried interest expense. Credit GP carry payable. This accrual is adjusted each quarter as valuations change. It reflects estimated future payments, not immediate cash outflow. GP commitment. Skin in the game. GPs typically invest 1 to 5% of the fund. This aligns interests and sends a strong signal to LPs. Entry on GP contribution. Dr. Bank, GP capital account. GP commitment is often the same economic class as LP capital, though sometimes on preferential or subordinated terms. Fee offset arrangements. Deal-related fees, such as monitoring or transaction fees, may be credited against management fees. Common offsets range from 50 to 100%. This prevents double charging by the GP and improves net returns for LPs. Always disclose offsets and net fee economics to LPs. Tax and legal structuring implications. Carry is often structured as a partnership profit allocation rather than wage income. This can create favorable capital gains tax treatment for GP partners. Tax treatment varies by jurisdiction, so legal structuring matters. SPVs and holding structures are used to allocate carry across GP members and manage tax efficiently. Governance. LPAC and audit oversight. Governance bodies like the LP Advisory Committee review valuation policies and conflict of interest matters. Annual audits verify NAV, carried interest calculations, and fee allocations. Transparent reporting of carry maths builds LP trust and reduces disputes. Example: full waterfall demo. Simple numeric demo to acre logic. Investment 100 crore. Exit proceeds 200 crore. Process 1. Return capital 100 back to LPs. 2. Hurdle 8% over the period. Assume 40 rupees LPs. 3. GP catch-up 15 rupees allocated to GP until GP reaches target share. 4. Residual profits. Remaining 45 rupees split 80-20 LP, 36 rupees, GP 9 rupees. Final totals. LPs receive 100 plus 40 plus 36 equals 176 rupees. GP receives 15 plus 9 equals 24 rupees. This illustrates how capital priority and hurdles shape final economics. End. Example: journal entries for carry payout accrual during life. Doctor carried interest expense, current GP carried interest payable. When paid, Doctor GP carried interest payable, current bank. Maintain a clear audit trail showing how accruals were computed and updated. Red flags in GP compensation. Watch for these warning signs. High management fees with weak performance. Aggressive carry accruals based on optimistic valuations. Misclassifying return of capital as profit to accelerate carry. Weak or unenforced clawback provisions. LPs should scrutinize these areas during due diligence. Closing summary. Management fees provide operational stability for the GP. Carried interest rewards superior outcomes and aligns GP incentives with LP returns. The waterfall, return of capital, hurdle, catch-up, residual split, defines payment order clearly. Clawbacks, GP commitment, and LPAC oversight maintain fairness and alignment. Final takeaway. Carried interest is where private equity wealth concentrates, but it's gated by capital return and hurdles. Master the waterfall, and you master how incentives shape behavior, timing, and ultimately performance in private equity.